Hey guys, it's Carl Allen. Got a really cool video that I want to do for you today. I've pulled the whiteboard out of my office in my Florida home into like the main lounge area because better lighting, and I wanted to do this video for you. So I want to talk about the difference between seller financing and an annuity deal, okay? So in terms of a deal structure, they're actually exactly the same. So seller financing on a deal is where you're paying the seller future payments from the cash flow that the business is generating once you're the owner. This is very different to an earnout. I'll do a separate video on that. But seller financing is a contracted payment. The debt sits on the balance sheet and then you amortize the payments over a period of time. Sometimes you have interest payments in there, sometimes you don't. So let's say you were doing a deal. Let's say you agreed a deal with the seller. The business is doing $400,000 per year of profit, which is called EBITDA. And let's say you agreed to buy that business for a 4x multiple. So $1.6 million at 10 years, which is $160,000 per year. So every year for 10 years, the seller's getting $160,000 a year, and you're banking the rest, right? So you're banking the difference between the 400 and the 160, which is $240,000 a year or $20,000 a month, right? So that's what you're making out of the deal, right? So to position this type of deal, we turn it into something called an annuity deal. So it's exactly the same structure, exactly the same terms, exactly the same legals, but we focus on the major benefits of the annuity deal to the selling business owner. So what are they? So number one, they get more money. So depending on what sector that business was in, we could determine what the value, what the multiple would be. So normally a $400,000 a year EBITDA business might sell for 2 to 2.5x EBITDA as a multiple, right? So the fact that you're paying 4 times instead of say 2 times, you're actually paying the seller double the amount of money for the business, albeit over an extended period of time. And it's just like going and leasing a car versus buying a car, right? So if you wanted to buy a Tesla, you could rock up to the dealership. Let's say you wanted to buy one of those new Tesla Ys, and let's say they're $50,000. If you were to finance that over, say, 6 or 7 years, you'd probably end up paying $60,000, $70,000, $80,000, depending on what the terms are. Same with a house. If you buy a house for cash, you'll pay what the house is worth. If you mortgage that house over 10, 20, 30 years, you'll pay a lot more for the house, right? So it's exactly the same in an annuity deal. We're basically offering the same sort of terms that you would get when you're financing the purchase of whatever it is, right? Whether it's a car, a house, or anything like that. So benefit number one is the seller's going to get more money, right? Benefit number two, the seller is going to pay less tax, right? What does that mean? So if you did that deal, even at a 2 times multiple, 800,000, let's say $2.5 million transaction, the seller's probably going to pay half of that in tax, right? So they're going to net $500,000 from the proceeds, then they'll have broker fees, they'll have closing costs. They might end up with only $350,000 left to go and invest. And if the seller wants retirement and they want income versus capital gain, that might not be enough money for them to live the life that they've become accustomed to, right? So by paying them a monthly payment, so what they do is they're only taxed when they receive the money. So the IRS changed the tax code. It's code 237. They changed it a few years ago so that the seller only pays the tax when they receive the money from you, right? And it's also taxed as a capital gain, yet it's actually income to them in their pockets and in their bank accounts. Number three, probably one of the biggest benefits, it's a lot faster, right? So if you were doing the original deal, let's say you were paying $1 million for that business at 2.5 times the $400,000 of EBITDA, then let's say you decided to go to the SBA. You went to a bank like ReadyCap or Live Oak or Chase or whoever it was, and you decided to do that deal through the SBA 7A loan program, right? Yet you'd have to put some equity down and all those different things. But the problem is that deal might take 4 months. It might take 5 months. It takes a long time to do an SBA loan, right? Because they've relaxed the rules. A lot of people are utilizing that deal structure, that funding stream right now. So the SBA hasn't quite caught up with the processing power it needs to get all these loans through, right? So an SBA deal could take 4 months. An annuity deal can take 4 days, right? Or 1 to 2 weeks maximum, right? So it's a much faster deal. So if you've got a seller with a high degree of distressed seller psychology and they want to come out of the business super quickly and they don't want to wait 3, 4, 5 months for the capital to land, that they're going to lose a lot of it in tax, right? So a faster deal is one of the really, really cool benefits. Point number 4, it's less stressful. What do I mean by that? So if you do an SBA deal, the bank and the SBA are going to be all over the seller for data and information and business plans and tax returns and legal structures and all those different things. They're going to do an awful lot of due diligence. The more money that goes into a deal from an outside party, the more due diligence that the deal actually needs. So with an annuity deal, you can do very, very, very light touch due diligence. Just make sure they've paid their tax returns and then just have your attorney double check a couple of hours that the business is safe to buy. There's no big pending litigation or there's nothing seriously untoward with the legal documents, right? So it can be a lot less stressful. And then number 5, we touched on it before, it's really income versus capital gain, right? So the money's not taxed as income, it's taxed as capital gain, so it's lower tax, but the seller treats it as income because they're getting that regular monthly payment through the seller financing, which, because they're getting a lot more of it, it means they can live and have a much more enjoyable retirement. So just to summarize, seller financing deals and annuity deals are exactly the same. The annuity deal gives the seller more money, they pay less tax, it's a much faster deal to close, it's a lot less stressful because it's a lot lighter touch due diligence, and you can provide income to the seller versus capital gain, although it's still taxed as a capital gain. Now, let me tell you a quick story about where the word annuity deal came from. So I was on a phone call with a seller a couple of years ago, and we were going through the numbers, and he wanted like a 6 times multiple for his business, and it was really worth a 3 times multiple, right? As you know, there are lots of sources that publish the multiples for what businesses typically sell on average in any industry. So his business was really worth a 3x, but he wanted a 6x. And I asked him the question, I said, hey, your business must absolutely be best in class for you to want a 6 times multiple. Tell me about that. He said, what are you talking about? Multiples? Like, a CPA is not valued my business. It's been valued by my wealth manager. I said, really? Wealth managers are not trained to value business acquisitions, right? They're trained to manage your money and provide you with a return. He said, well, I know that, but I told my wealth manager that I was going to retire, I was going to sell my business, and this is how much money I needed, $12,000 a month, I think it was, to retire comfortably for the rest of my life. So all the wealth manager did is calculate what would the size of the money market product that he would have to buy that would churn out the $12,000 a month, and then he reversed engineered that by adding back the tax and the fees and all those different things. And that created this massive valuation, which when you divided that by the current profitability of the business, gave it a big spiky multiple. So I said, well, hey, now I understand what you're doing. Why don't I just become your annuity provider? Why don't I just pay you $12,000 a month out of the business? And he said, you would do that? You would do that for me? I said, absolutely. Yeah, of course I will do that. No problem at all. And because there's surplus cash in the deal, we can use that to pay the closing costs. So it's not going to cost you any money to do this deal. And then you sell, we can do this deal in 3 or 4 days, and then you can get that regular monthly payment for 10 years. He said, wow, that's amazing. And then he paused and he said, well, so the only thing I got to figure out then is my money safer in my own business, or is my money safer in the stock market where I can't control it? And he said, I'll tell you what I'll do. Give me 10% retained ownership of the business so I can stick around and still have access to the bank accounts and all those different things. and I will do that deal, right? So that's why I call it an annuity deal, because it came from a seller that wanted the closing proceeds to buy an annuity product in the market to pay him a regular income for a 10 or year period or more. So that's where it came from. That's the difference between seller financing and annuity. Exactly the same transactionally. It's just how you position it and how you sell the benefits of that deal to the business owner. Hope you found that useful. Don't forget to hit like and subscribe to this video so I can give you all of my videos in real time. And if there's any question that you're needing an answer for, definitely hit me up in the chat, type that question in. My team will get back to me and I'll record a video just for you. So I will see you soon, guys. Until then, bye for now.